I think that what we saw was interesting because we didn't really break above highs properly a month ago. Crypto with 150 million users is growing at 113% a year. So we go, because it's an exponential trend, we go from 150 million users to 1 billion users by 2024. That's how fast this is growing. Currently, it's a $2.5 trillion market cap. If we look at how fast tokenization is eating into other assets and growing itself, and we look at those adoption numbers, then the reality is all of the other asset classes, global equities, global bonds, global real estate, are all between 200 and 350 trillion, with the derivative market being 1 quadrillion and FX even bigger. Thought process is that therefore, if crypto goes to 250 trillion, which sounds about right, and
100x in 10 years
of an entire asset class, we've never seen anything like that. Mankind has never seen a larger wealth creation opportunity in a shorter period of time in all of history. Even oil didn't happen as fast as that because there wasn't enough uses for it. This, because it's digital and built on top of the internet, means you've kind of got Metcalfe's law on top of Metcalfe's law. So the exponentiality of the returns is simply gigantic. Now, let's say Raoul's an idiot and it all goes to zero. So the downside is, let's say I'm going to use Ethereum and let's call it 4,000. We lose 4,000, but if it goes 100x up, you would take that risk reward forever. Now, it's not going to zero. Is it going to go down 50% to 2,000? Let's say that's the risk. So it's 50% downside, 100x upside. That's a 200 times risk reward. This is why nobody cares about most of the macro stuff anymore, because we all saw the rise of the other Metcalfe's law business models like Amazon, Google, Facebook, Apple, even Tesla. And we're seeing this again, but in an entire asset class of which we can participate this time as both participants in the networks and owners of the networks. And it's available to everybody. If I'm right, and let's say you're a cynic and you put in 1% and I'm right, you can double your net worth with a 1% allocation. You can be a cynic and take the bet. Or you can be like me and a large part of your liquid net worth into it because you really want to capitalize on it. Fine, you take your journey, you take your risk profile, that's all good. But to not have it makes no sense whatsoever. Again, you might not like it. You may not agree with it, but nobody cares what you think. The market is what matters and the adoption effect. Again, people become emotional about assets. I have basically enough in the bank account to pay my bills. Every single other penny is in this. Sure, I've got shares in Real Vision and all that other stuff, but that's not liquid net worth. That's all private stuff, and I've got houses and stuff. This is every single penny. So do what I do. It sounds ridiculous, but it works really well. You put the money in, you know your overall risk, what you're prepared to lose. Let's say it's down 50%. That's a reasonable estimate of what you should be not concerned. We had a 50% drawdown this year. So you say, well, 50%, maybe even 60%, maybe 70%, whatever the ridiculous number is. And then you don't look at your P&L. You can allow yourself to look at the P&L at all-time high, just so you can just smile to yourself. You don't look at it. You can look at the market. I mean, I've got the charts up. I've even got the bloody hourly chart up. I don't trade hourly. I don't trade my position at all, but I look at it because I like to kind of follow the structure of the market. I match my investment horizon with my time horizon of the trade, and I satisfy the adrenaline buzz by messing around looking at short-term charts. I don't trade at all. So again, people are linear. They look at the world as is today and they can't look forwards. Why would I invest in, let's say, Apple when they brought out the iPod? Well, there's two ways of looking at that. I'm not going to use an iPod and therefore, or I don't see the value right now. I've got a record collection or I've got a bunch of CDs, right? I don't need that. It's fine. I love my stereo at home. Or the person who looks at it and said, holy shit, this is the future of digitizing all music, putting it on a small device, and that leads to the mobile phone, and that leads to computing power of huge scale in your pocket, which leads to the entire mobile revolution, that leads to the entire app development scene. That is the difference in linear thinking. So people are saying, well, where's the big consumer app? Well, guess what? By the time the huge big consumer apps are out, most of the value's been captured already. You're always going to be too late. It's like people are doing it with Tesla. It's hilarious. They don't understand that what you're trying to do in these growth style opportunities is look 10 years out, not this year's earning or this year's application. And people just struggle with this. This is really important. You're playing an exponential trend, not a mean reverting trend. You're crazy to rebalance. You might periodically, because you want the cash, to take top slice profits.
I agree.
Really, you need to hold the position because your view is a 10-year view. So don't trade on a 1-year basis or a quarterly basis, because then your trade horizon doesn't match your time horizon, which was the basic thing that Paul Tudor Jones taught me, is the best people in the world, trade horizon matches their time horizon.
But what would cause you to change your mind on crypto and digital assets?
A significant slowdown in network adoption. Because if that's the pricing model, then we live and die by that. If we're seeing the network die, then the network's not less valuable. Simple as that. Now, we can have slowdowns in network growth, but if it kind of breaks out of the logarithmic trend, then you've got an issue.
Everyone is looking for the blow off to end this cycle. Is it possible? I'm thinking back to October when Shiba Inu and Sandbox that you mentioned did so well. Was that maybe the top of the cycle?
It's possible. I don't think so, because I know how much institutional participation is still to come and hedge fund participation. So I don't see it being the top of the cycle. I think that what we saw was interesting because we didn't really break above highs properly a month ago. We didn't get the retail going, I've got to get in because it was headlines, crypto makes new highs, goes up another 50% this month. We didn't get that. Sure, we got some in March, but that's pretty normal at that stage in the cycle. Feels like the cycles are elongating.
And two final questions. Looking ahead into 2022, and I don't know if we're still going to follow that 400 days before the Bitcoin halving cycle, things really go down. Maybe we do, maybe we don't. But how would you look at, as far as you could look ahead with your charts and what you follow, could we have a great bull run in the first quarter, but we're inevitably going to have more bear and volatility? Or could we hit a hardcore winter where things go down and stay down?
Yes, is the answer to all your questions.
I guess it's going to be a fun year next year.
I think we'll have, it could be either. I don't know. I'm no guru. My best guess is institutional participation drives and hedge fund participation in the first quarter drives retail participation, which drives a final stage bull market, of which ends when ETH 2.0 is launched, which I think is like by the summer. If it stays within the log channel, let's call it the weekly or monthly log chart channel, like Amazon has and Facebook has in their entire history, then there is nothing wrong. It is just part of the natural order of volatility of a network model stock.